Welcome to Trading Nation. I'm Brian Sullivan. Very pleased to be joined today by veteran strategist Ned Riley, CEO of Riley Asset Management. Ned, it's been a while. Thanks for joining us. We appreciate it.
Oh, my pleasure, Brian.
All right. I know that just from notes and emails and chatting that you're not nervous about the market. However, something that I've been talking about on my show on CNBC a little bit is that I do worry that there's too much of the market is too few stocks. It's something like five stocks, Apple, Facebook, Google, Amazon, you know them, are 40% of our gains from a market cap weight perspective. And I do worry, what if they roll over? Are we too narrow of a rally?
Well, my judgment that the rally isn't that narrow, but you are right, Brian. We've got a very few stocks that are carrying this market higher. However, it will bring out another period in which we have similar things happening. It was back in 1972 and 3 when Polaroid, IBM, Xerox, Eastman Kodak, they all maintained multiples in the 50 to 100 times earnings, and they were selling on base of growth rates of around 15 to 20%. Obviously, a lot happened to bring that down like a house of cards and to stay in the doldrums for the next 10 or 12 years. My feeling today is there are fewer stocks obviously driving this market up than there were 2 or 3 years ago. But all I feel is it's a recognition of investors that these stocks clearly do have value. They have mispriced them in terms of price-earnings ratios relative to their growth rates. When you start to look back now on these companies, they have had a long-established growth record in terms of earnings per share, and it has not been recognized until now. Second, the excellent earnings records have been established during some pretty tough times. Yes, some companies have been somewhat cyclicized in earnings, but most of the companies have gone through this trend with a much higher secular growth rate, and to me, that is a very critical issue. The third has to do with valuation. And when that occurred back in 1970 with those stocks, or I should say in 1972, 73, when those stocks sold at 40, 50, 70 times earnings, there was no cushion underneath them at all because those are obviously too highly priced stocks then. Look at it now, valuation isn't so ridiculous. I hate to use Apple as an example, but just 5 months ago, I did your show, and I said that Apple was probably the cheapest stock out there. And it's still the cheapest stock out there. It's selling at just about 1 time its growth rate. It should be selling at 2 or 3 times its growth rate. And there are many others that match up the same way. Valuation for some of these larger and more successful companies have P/E ratios that are below 2 to 1 in their PEG ratio. In other words, they're selling at a multiple that's less than twice the growth rate. I use that as my rule of thumb, Brian, to be honest with you. If a company can grow at 20%, I would say it deserves a multiple of around 40 times. Now, that's not the most scientific, algorithmic way to look at a stock, but it's a pretty good handle if you go back over the last 20 years. Now, if you look at the market in the same context, we see an inflation rate of 2%, an earnings multiple at 18 times, which comes out to about 20. Compared to the growth rate of the S&P 500 in terms of earnings per share is only going to 5 to 7%. So the S&P is actually selling it at a higher multiple in terms of PEG ratios from some of these companies.
That's an interesting point of view, I guess, and I'm, it's comforting to hear you're not concerned about the valuation of the big five because, I guess my thinking is but you're the market expert. I'm just an observer, Ned, and for me it's, well, if all the algorithms and all the automated trading and all the ETFs are just buying the same 5 or 6 stocks, what happens if they change their mind and the algorithmic, the computers decide that these stocks are overvalued? There's part of me that worries that is there enough human intervention? That said, what does? Oh, go ahead.
Brian, it's out there looming large. The problem there is right now is that people are still buying bonds and not buying stocks. And if you kind of look at the money flows into the mutual funds, ETFs have been gathering a lot of assets. But in reality, bonds over the last 2 years have gathered in more assets than stocks. So even though people may cry that it's expensive and everything else, you're buying a more expensive market in terms of bonds, as far as I'm concerned. Now, with few exceptions, the average established tech company has a pristine balance sheet. The balance sheet looks beautiful. Apple's, Microsoft's, anyone that you pick. But there's been great criticism over what they've done with their money. That is, buy their own stock back or pay a larger dividend to shareholders. The good news about that is they're buying companies back that have a return on equity of 25 or 30%, or return on capital exceptionally high. That is their own company. So in other words, they're taking their money and putting it in a place where obviously there are fewer options than their own company. And to me, that's a positive and smart way to spend your cash. The dividend, some of it comes back to the company, obviously, but the bottom line is they are buying value that they see as value, and they've got a lot of money to do it.
What does worry you?
Oh, it'll rain up the Northeast sometime today or tomorrow. No.
It's been raining for about 3 weeks straight here, Ned.
I know. I don't wish that upon you anymore. First thing that really bothers me is that the inflation numbers in this country are all wrong. A 2% inflation rate may be running according to it statistically, but I suggest that the inflation rate may be closer to 3 to 3.5%. With that, obviously the yield on longer treasuries should be higher by at least 1.5% to 2%. And unfortunately, I don't think even my great growth stocks will do well if this actually materializes. I said it's a threat. It's out there, and people forget that during the periods of sharpest correction is when inflation started to accelerate dramatically, whether it was in 1973, back in 1980, back in 1987, and back in the year 2000. All those periods were punctuated with a very high inflation rate and accelerating. And if there's something for me to worry about, it's that.
It's good stuff. Hey, a really interesting discussion, too, into the valuations there, Ned, and we appreciate it. Because I know, listen, it's not people aren't worried. They're obviously still buying the stocks. But, every time we go up and if we don't see earnings go up as much, then there is probably some concern out there. That's why we appreciate you joining us. Thank you, Ned Riley.
My pleasure. Thanks a lot, Brian.
Sure thing. Good to chat with you again. Folks, interesting views there from Ned. Thanks for watching. I'm Brian Sullivan. We'll see you next time. Take care.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.